Okay, traders, just want to make a video on the state of the equity market and some of the interlinked trades between the credit and the equity market and how you can monetize it, and some of the opportunities I see further afield. First thing to understand is we have to go back to August when Fitch downgraded government debt from AAA to AA. Obviously, this is what I'd call a domino effect. Since then, we've had various other issues. I'm going to talk about policymakers and is there a risk for a full-blown debt crisis, corporate debt worries, things like this. And the real problem, as I've said, is government expenditure, not just in the UK, but across many nations. And if you go back to the UK from the mid-40s to the mid-70s, we were growing at a rate of about 2.6 to 2.8% year on year. That rate today is about 1.5%, and it's unlikely to increase. The big kicker, and I want to talk about the American markets and a little bit on the UK markets, is for Britain, national debt, about a quarter of the national debt is index linked. So as you raise rates, and of course the cost of borrowing goes up, you're going to see an explosion in the cost of government service costs. And this year alone, the government's on track to spend about 100 billion in interest costs alone, which is more than any departmental budget. It's higher than defence, it's higher than education, and it's only just below that that's spent on pensions. So it's an extremely large sum of money. And this is important because I'm going to come back to this later in the video and explain why it hasn't reached the mass market yet, why people aren't talking about it, and where the opportunities are to trade and to monetize. So let's look at corporate debt and talk about that. You know, I'm seeing corporate distress, but it's in the infancy stage at the minute. A lot of the firms are struggling to service their debt, okay? But what we're actually seeing is with the rising costs of credit default swaps, this sort of thing, where do we go from here? Well, at the minute, according from my rough calculations, by next year, there's going to be about $500 billion of corporate debt that will have to be refinanced, starting early 2024. And pretty much all of these refinancings will be at higher rates than they are today. Let's just unpick that last sentence a little bit, because if the corporate refinance, if the floating rate of debt is going to be higher, which we know it will be, there's going to be higher lending margins on top of that because the price of risk has gone up. So if these companies are, if they're refinancing fixed rate debt, they're going to have to pay a coupon that's going to be higher than the benchmark, plus some sort of higher risk premium. What does this mean for interest costs for some of these companies? Well, a lot of these companies that we're looking at, and I'm aggregating a list of them, are financed largely by debt. And if the debt skyrockets, which it's very likely will happen, it's going to impact the bottom line of these companies. And these companies are going to pay less dividends because of that. The price earnings will come down and the equity values will drop. But where it's particularly interesting is in the defensive sectors, where people who own Dow Jones and these defensive, sectors, they're going to struggle. Look at things like the airline sector, cruise liners, heavily relying on debt, and the debt goes up. They're going to stop paying out dividends and the equities will come down in price. So this is where you need to be looking more than anywhere else, in my opinion. And so we haven't, I've touched on inflation in other videos as well. That it was supposed to be for a brief period of time and then we'd come down. We haven't yet seen that. And so there's going to be these interplay trades between credit and equity markets, but they take time to play out and to pay off as well. And if we look just at the central banks briefly, what we're actually seeing, and I'm talking about leading central banks here, We've had 13 years, more or less, of 0% rates, followed by mass money printing. And where are we today because of that? Well, we're not doing particularly well. Where people are not talking, after successive QE programs, the Bank of England has purchased huge quantities of UK government gilts. Most recently during the pandemic, there was lots of bids. So the government is right now sat on a portfolio of gilts that are declining in market value as rates go up, because you've got that inverse correlation. And this agreement goes back a number of years. The Treasury has to reimburse the Bank of England for the decline in the market value of their portfolio. So when we look at some of the estimates, the Treasury potentially will have to pay the Bank of England 120 to 150 billion pounds over the next 10 years. And that's in addition to paying the coupons on those gilts, which they can't get out of, okay? So a lot of people have not contemplated that this sum is nearly equal to running the NHS for 1 year. And there's going to be, issues when this comes to light, and it will do in time. So, and of course, as the easing transitions to tightening, that is selling these portfolios of bonds in the open market. So the bonds, and particularly the gilt prices here in the UK, have been falling, and therefore, pushing up the yields. And it means that the governments will have to pay more for newly issued debt that's coming out going forward. If you look at the likes of the European Central Bank, they've been doing what I call passive tightening by basically not reinvesting the redemption of value of their bonds as they mature. But this has got some consequences for the balance sheets of these central banks. Even if much of their bond portfolio losses are still what we call unrealised, they're not crystallised yet. And then moreover, on top of that, the interest paid on the overnight commercial bank deposits, which are with all major Western banks, of course they have to be settled at the end of the day, now in many cases exceeds the coupon income received from their bond portfolios. So basically, in other words, these central banks are losing money and the capital basis is dropping, they're in decline. But no one's mentioning this because it takes a long time to play out for us traders to make money off this. So I suppose in theory, the takeaway is that these central banks could operate with negative capital because at any moment, you can wave a magic wand and create money to refinance it. There's two issues I see here that make this undesirable. Firstly, the issue of the money printing. As we now understand, it's inflation, especially when we've already got rampant inflation really across the board. There's only a few economies like Japan that seem to be doing okay because they didn't tighten so fast. And then secondly, a lot of the central banks, if they look like they might fail, what will happen is a lot of the FX traders will come in and hammer the currency. And that's why the likes of, if you look at Sweden, they are requiring their central bank to recapitalise in their own local currency. So we could see models like this for the Bank of England in the near future. So I would keep an eye on this. And then the last thing to keep an eye on is the pension funds. Many pension funds in the UK are very exposed to the government and the corporate bond market. And no one is talking about this. Pension funds, we track a lot of them. We track asset management firms here in the city like Schroders, big funds that are ploughing money into equity shares. So keep an eye on this. So that's just, as I say, I wanted to talk about, the fall in these sort of pension funds. Are they going to be in deficit? Technically the value of the assets has fallen, but the value of their liabilities has technically declined. as interest rates have gone up. So lack of capital flowing into these stocks is one reason why some of the UK markets may look cheap on a valuation basis. And if these growth stocks do look cheap, they get snapped up by foreign buyers quickly, and then the whole cycle repeats itself, which is not an uncommon way for the UK markets to go. So there's trades between credit and equity, both British and American equities, and the credit market here in the UK and further afield in the US. But again, it comes down to pricing in. It seems like the markets have basically come to the decision that you're not going to spike much higher from the current levels. But we stay around these levels for quite some time. So I hope that clears up some of the credit markets. This is a very broad and brief commentary on some of the things that I'm seeing and where the opportunities are in travel, leisure, entertainment stocks. As this almost $500 billion has to be refinanced next year. You'll see dividends cut, and therefore you'll have analyst calls dropping. So it's going to be interesting times, and we're positioning both long and short on the portfolio and preparing for various outcomes and of course hedging. So I hope that clears up what we're seeing.